Hello friends, in the last 2 weeks, I have been telling you that the markets do appear to be slowing down a little. Last week I told you that the bulls may seem to be tired, and in the week before last I said, will the rally extend or not? We analyzed all that with statistical evidence. And in my live mint column I told you, make haste slowly because statistical evidence seems to be pointing towards a slowdown. What is the outlook ahead? We take that in this video, and I've added a special segment of what I would do in the coming week. I hope it helps you trade better. Let's dive right in, and on your screen right now is the market roundup window, and what it tells us is that the broader base Nifty 50 led the decline and the bank Nifty brought up the rear where falls were concerned. The US dollar index fell a little, but the USD INR rose, which means the dollar eased against the global basket of currencies but strengthened against the Indian rupee. Now that explains some of the declines in our domestic markets, and a falling dollar boosted crude and natural gas prices. Do remember, this is cyclically a period of bullishness in energy, and I've said that in my past videos as well. Now, gold and silver moved in divergent directions. Gold gained a little, silver witnessed a little bit of profit taking, but overall they maintained their optimistic outlook. The 10-year benchmark bond yield fell a little, which means bond prices rose marginally. The NSE lost market capitalization, which is but expected on a negative week, and the MWPL rose, which is normal till the third week of any derivative cycle. The US markets provided headwinds, and that's not really surprising. The US Federal Reserve raised interest rates. I have been warning you constantly through my editorials in our free Telegram channel that cost of funds is going to go up, and a lot of people, unfortunately, sad to say, are taking this very lightly. On your screen right now is a daily chart of the US Dow Jones Industrial Average, which fell on 3 out of 5 trading sessions last week, and Thursday's fall in particular is very, very prominent to the extent that it's a power candle, one of the biggest candles in recent history, and that basically has set the tone and tenor for a weekly decline. The 34,281 last mile resistance has come back into play, and the 200-day moving average acted as a support. So what we need to watch now is 32,600 on lower levels as declines and 34,281 levels as a resistance on the upside. We need a breakout in either direction to basically tell us where the Dow Jones is headed next. Now the Nasdaq 100 index, which directly impacts our technology stocks, still remains under pressure, fell on 3 out of 5 trading sessions. The death cross, the 50-day moving average remaining below the 200-day moving average, is still in place, and the index has fallen below the 11,682 level, which I wanted to hold as a support. Ever since it fell below this level on Thursday, never really recovered. So technology stocks in India may just feel the heat. The broadest index of them all, the S&P 500, could not go past the 4,119 levels last week, even though on Tuesday it did make a valiant attempt to go past the 4,100 mark, but cracked downwards. Death cross remains in place, and what we need to watch out for is whether it will go past the 3,920 odd levels, which is the 20-day moving average. Net, US markets look like they are under pressure, at least for the short term. Coming back to our domestic markets, let's take a look at the MWPL. It is now almost at the highest of the 20-week period that is covered in this chart. Will the MWPL rise from here? Fair probability. Do remember, market-wide position limits tend to go up till the third derivative week of the cycle. So we are probably going to see the highest MWPL in recent times, but that need not necessarily be good or bad news. You see, a big build-up would mean that if market turns adverse, there will be a whole lot more selling, and a good build-up also means that if the market rises, there will be adequate cushion on the downsides. But the one thing that we are sure about is that statistical beta or pure price volatility will rise. So keep an eye on this. I update MWPL on my social media accounts every day. Now for the stock and index futures turnover, what we are seeing is a slight inching up of the turnover in both index and stock futures. This is a cumulative 3-month figure. So it's December, Jan and Feb. By the time the budget comes on the 1st of Feb, we would have seen these data coming into play. The fact that markets fell on higher traded volumes is a slight small red flag. Now for the NSE advanced decline ratio, what we are seeing is that the index continued to fall for the second consecutive week, and the NSE advanced decline ratio continued to remain below the 1 level for the same period. Although qualitatively speaking, there was a marginal improvement because in the week gone by, we saw the average of 5 trading sessions, NSE advanced decline ratio at 0.9, whereas it was 0.85 in the week prior to that. So even though it remains weak, the relative weakness was reduced. But overall, I would want the index, the advanced decline ratio to stay above 1. This is another of those studies which I share for free on our social media accounts. Now for the basis. The basis is nothing but the premium or discount enjoyed by the future over spot. And higher the basis, more the risk appetite and willingness by the traders to pay a premium. What we are seeing is that the bank Nifty basis has fallen for the third consecutive week and fairly sharply. And the Nifty basis has also compressed, although at a slightly easier pace. But as long as the basis does not invert, which means the future does not trade at a discount to cash, bulls still have a chance. They just need to provide a lot more buying support. Will it come? The future week will tell. Now for the impetus. This is something that you have learned to trust over the last year and a half. And unfortunately, impetus for Bank Nifty and Nifty has risen from the period low. Last week, I told you the impetus what is a period low, and therefore big moves could occur in any direction. Here you are. The markets actually nosedived from Thursday onwards last week, and the impetus has increased with declines. That tells you that force actually went up on the sell side. This is another one of those very tiny, small red flags. Now for the LWTD, which is something that I've started sharing a couple of quarters ago, what we are seeing is that the Nifty percentage gain loss line remained below 0 for the second consecutive week, and so did the LWTD. The LWTD actually fell deeper into negative territory compared to the week prior. So buying support on declines might just be relatively muted as compared to the previous week. Do remember, I've also written about this in my Live Mint column and said it in my videos here. December is a time when FIIs go on annual leave, so traded turnover and fresh buying risk appetite may be curtailed, which is a usual thing for a student of market history. So keep your ears to the ground and keep watching out for the hooves of the approaching horses. Now for the 4 market participant types, starting with FIIs who've reduced their long positions in both index and stock futures, so they seem a little circumspect. Where DIIs are concerned, they've reduced their net short positions on index futures whereas they've increased their net short position on stock futures. That is basically taking a hedged approach. Now, for prop traders who've basically been doing all the heavy lifting, what they have done is taken a higher risk appetite approach in increasing their individual stock futures longs, but they've hedged that by shorting or increasing their net short positions in index longs. So they're taking a very balanced approach. What is the retail guy doing? He's basically been propping up the market ever since the COVID-based lockdowns, and his net long positions in individual stocks is at a 20-week high of the chart. You're back again to 1.25 million lots in individual stock futures. They've also increased their index net long position. So they seem to be basically buying into the declines. Friends, I now come to the 4 index heavyweights and what their signals are. I start with the biggest boy of them all, Reliance Industries, with a weightage of 11.36 and a higher beta of 1.07 compared to the Nifty 50. What you are seeing is that this heavyweight fell on 3 out of 5 trading sessions starting from Wednesday. After Wednesday, it never really looked up. It's closed below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average itself is being dragged lower, and we need to watch whether the 2,540 odd levels, approximate level, holds or not. If that is breached, it could drag the Nifty with it by the sheer weight of its weightage. The second stock, HDFC Bank, second highest weightage in the Nifty, but the highest weightage in the Bank Nifty. It fell sharply on Thursday, and what a pronounced sharp fall. But it showed an equally large prominent bullish candle on Friday, taking support at the 25-day exponential moving average, which is a month-long holding on cost of a bull. The average itself is rising. So HDFC Bank, relatively speaking, looks better poised than Reliance Industries. And this stock will boost both indices, the Nifty and the Bank Nifty, due to its presence and weightage. The third heavily weighted stock, Infosys, which of course is down because we saw the Nasdaq 100 index exhibiting sheer weakness in the markets. And what you are seeing is that the Infi stock price has fallen on 3 out of 5 trading sessions. The decline, which started on Thursday, never really allowed the stock to rally. You have a pin bar formation on Friday, which tells you that the IT sector is under pressure. Friends, I have recorded a video in the past cautioning you against paying heed to the norm of standardization or a Pavlovian approach. If the rupee is weakening, buy technology stocks. I've made a video of why you should not do that. The hyperlink to that video is in the description and in the end screen of our video here. So tech is not looking great, neither is Infi. The final 4th index heavyweight, ICICI Bank, the 4th largest weightage in Nifty and 2nd largest weightage in the Bank Nifty. This stock has clearly nosedived and fallen on 3 sessions starting from Wednesday through Friday. And the 25-day exponential moving average itself is turning lower. So the dice is now tilting against the bulls in ICICI Bank, and through that in the weighted indices as well. Friends, I now come to the bond market, which you know is fairly close to my heart. We are seeing bond prices have come down very marginally, 2 basis points. And on a week-on-week basis, the bond prices have gone up, which is why the yield has fallen. And this tells me that there's been a flight to safety. My online family will remember I have been advising you constantly to keep laddering, which means a fixed allocation staggered over a period of time so that you receive a good average yield for all the checks that you've written. So averaging and laddering at frequent intervals continues. And would you be or should you be writing another check at the present levels? I don't think so. Let bond yields go past the 7.45 or 7.50 before writing out another check. Now, friends, I come to the US dollar index, extremely critical for emerging markets, including India, because imported inflation or the landed price of imported goods is determined by the US dollar. The US dollar index, as you can see on your chart, fell on 3 out of 5 trading sessions last week. The price remained firmly below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So bulls are clearly under pressure. The 104.51 level, which I told you was a good support, was violated last week and the price has closed below it. Now, the longer it stays below 104.51, the higher is the probability that it will go towards 103. So we need to watch that. Just for those who don't understand the correlation between the dollar and the Indian markets, at least equity markets, are basically happy when the US dollar index falls. Now for the weekly chart, which exhibits a hammer, which tells you that there is a possibility that the downsides may be resisted by the bulls, but the price remains below the 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook has turned mildly cautious. Now, friends, last week I advocated a range between 107.37 on the upside and 102.49 on the downside, which held perfectly well. In the coming week, I expect a range between 107.24 on the upside and 102.44 on the downside. Friends, the US dollar index done. I now come to the Bank Nifty, which fell 0.95% on a week-on-week basis. It fell on 2 out of 5 trading sessions, but the falls were very big, especially on Thursday, where you can see on the daily chart on your screen that it was a power candle, a big, powerful candle which locked the declines. The price remained above the 25-day exponential moving average, a month-long holding on cost of the bulls. The average itself is higher. What we need to watch out for is whether the price is trading above the average constantly or not. A breach of the 42,500 levels on a sustained closing basis might change the sentiments for the near term. The weekly chart on your screen right now shows an inverted bearish hammer, which is bad news for the bulls. Why? The inverted bearish hammer tells you that the bulls attempted to push prices higher during the week but failed. So their attempts were abortive and the price settled in the lower end of the weekly range and a bearish hammer was formed. Do remember what I told you in the recent videos. The price is far away from its 25-week exponential moving average and mean reversion could occur. Now, what is mean reversion? Mean reversion means either the price falls towards the average, touches the average and starts to go up, or the price remains where it is, consolidates, goes sideways and allows the average to rise before the price can go up again. Now, whether this is a mean reversion or a reversal, time will tell, but it's too early now to call a reversal and a bear market. That much I can tell you. In the week before last, this index was at number 9 on the most volatile counters list in the statistical beta list that we maintain in-house. It rose 5 notches to go to number 4, which is not exactly very good news for retail traders. Why? Because a big heavyweight index like this, getting more statistical beta means a higher challenge for a retail trader. Last week, I advocated a range between 44,950 on the upside and 42,300 on the downside, which held perfectly well. In the coming week, I expect a range between 44,525 on the upside and 41,925 on the downside. Friends, the Bank Nifty done. I now start with the Nifty 50, which surrendered 1.23% on a week-on-week basis. It fell on 2 out of 5 trading sessions, but what a fall. Here again, Thursday was a humdinger, a game changer. The price has fallen below its 25-day exponential moving average, as you can see on the daily chart on your screen, and the average itself is pointing marginally downwards. Also note that the previous high of October 2021 at 18,604 could not be overcome on a sustained closing basis. The price has closed below that level, and therefore the probability of testing the 18,100, 18,150 level remains open, which is the April 2022 swing high. For the weekly chart, what we are seeing is a similar bearish inverted hammer that we saw on the Bank Nifty is appearing on the Nifty as well. Here again, let me remind you, mean reversion is a probability because the price is far, far above its 25-week exponential moving average, which is a 6-month holding on cost. So either the price falls towards the average or the price stays sideways and the average catches up with the price. Time will tell, but this is clearly a case of possibility of a consolidation or even marginal declines. Nothing untoward out here about it. Friends, last week this index was number 16 in our in-house statistical beta or highly volatile counters list. It jumped 6 notches to hit number 10, which is not great news, believe me. The higher the volatility, the more challenging it is for the retail investor or trader. Last week, I advocated a range between 18,975 on the upside and 18,025 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect a range between 18,750 on the upside and 17,775 on the downside. It's time to be careful out there. Do remember, we are approaching Christmas. Volumes will tend to fall, and therefore, you need to cut down your traded exposure. Friends, I now come to the last bit of statistical data analysis, wherein I present the footprint of the retail traders, where they are placing their bets. Is it index or stocks? Index are lower risk and stocks are higher risk. So high stock exposure would mean greater risk appetite. Then again, are they playing in futures, which is higher risk than options, or are they playing in options, which automatically mean lower risk? Let's take a look at the daily chart on your screen. What we are seeing is the sky blue line has basically turned upwards. So these are individual stock options. Although risk appetite has gone up on a week-on-week basis, it is through options, not through futures. Take a look at the olive green line, which is individual stock futures. It's more or less sideways, it's flat. So risk appetite hasn't expanded much in individual stock futures. What about index futures turnover? It has gone up slightly. So traders are taking a nuanced or a slightly cautious approach by taking a higher exposure to indices rather than stocks. Now let's take a look at the standalone index options turnover as a total percentage of the market turnover. Do remember, this segment commands a lion's share of the total turnover. Turnover here in the index option segment has fallen below previous Friday's level. It's explained by the fact that the index futures turnover has risen, whereas index options turnover has fallen. So that tells you that while risk appetite might have gone up a little in index futures, but the fact that traders are opting for index futures tells you that risk appetite net is lower. No denying that fact whatsoever. Friends, I now come to the most popular segment of this video for statistically minded traders, wherein I give you 5 stocks which have gained the most amount of impetus on Friday. So you take a smaller exposure, wait for large price moves on Monday, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. These stocks help scalpers. This list is valid only for Monday. If you want to be updated about this list Tuesday through Friday, please subscribe to our free Telegram channel, where I put in a lot of cool stuff for traders, including our market beating pivot levels for both commodities and indices. So On your screen right now is the impetus gainers list, which is led by RBL Bank at number 1, MCX at number 2, Hindustan Aeronautics at number 3, Dr. Lal Pathlab number 4, number 5, Berger Paints. Now, biggest impetus losers where you take big exposure, wait for small price moves, led by Britannia Industries, followed by L&T, FNH. Third is Mahindra Finance. Number 4, Aditya Birla Capital. Number 5, Dalmia Bharat. Friends, I promised you I would share my innermost thoughts about what I would do in the week ahead. Number 1, I would cut down traded exposure. Why? Because FII turnover is likely to fall as we head towards Christmas. So bid and offer spreads will widen. To me, as a professional day trader, I'm very sensitive to the spreads. The spreads will determine how much the market makers will take a bite out of my traded profits and how much will I be able to bring home net of execution cost, commissions and taxes. So a wider spread is a cost and it takes away my profits. And from here onwards, believe me, take my word for it, spreads are going to widen as Christmas and New Year approaches. So number 1, I'll cut down my traded exposure. Number 2, I will play the interest rate sensitives for theta decay and wait for volumes to return back in January in these counters. If you've been following my Telegram channel, I have been constantly expressing my views about cost of funds going up, coupon rates going up, and what it implies for interest rate sensitive stocks that use money as a raw material and or both finished product. So if the cost of funds is going up, the raw material cost of these companies is going up, which means possibility of smaller profits. Now, what do I mean by theta decay? Theta decay would mean writing or selling an option, waiting for the premium to come down and covering it back at lower levels. This would be a good time for theta decay on interest rate sensitives, provided you pick your counters well. And I would basically, like I said, trade light, but I would tweak my risk reward ratio. No more would I aim for 1:2 risk reward. I would rather go for 1.1 to 1.25 or maybe even 1:1, because from now on, as the FIIs go on leave, they could basically be triggering lower turnovers, which means price mobility may not really be all that great. The price will get eaten up by the bigger spreads. So I would want to get out faster, even at 1:1 risk reward ratio. Friends, that's all I have in this week's video. Thank you for your patience in being with me in this video. I would love to know how my videos are helping you become better traders, and do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Comment section always open. Love to hear from my online family, and I wish you have a very, very profitable week ahead. Take care. Bye-bye.